Ethereum sidechain Gnosis launches Visa-backed debit card directly connected to crypto wallet. Blockchain network Gnosis has unveiled two products that allow users to spend their digital assets directly from wallets using Visa's payment system. Gnosis launched Gnosis Pay, pioneering the integration of decentralized payment networks with traditional processors, and Gnosis Card, a self-custodial Visa debit card directly linked to an on-chain wallet. The announcement was made during the Ethereum Community Conference in Paris. Gnosis Pay operates as a Layer 2 solution on the chain, ensuring faster and cost-effective transactions. The services are initially available EU and EEA countries as well as the UK. Gnosis plans to expand into the US, Brazil, Mexico, Singapore, and Hong Kong by the end of this year. The Gnosis card aims to ease the transition of crypto assets from centralized exchanges to self-custodial wallets, enhancing Gnosis's blockchain ecosystem. This means that the Visa-powered debit card directly takes funds from the user's wallet rather than requesting users to prepay the card. This is different from Web 2 payment networks because you still have custody of your funds. It is different from Web 3 payment cards because it is not prepaid, Friedrich Ernst, co-founder of Gnosis Chain and Gnosis Pay told Decrypt. Per the announcement, Gnosis Pay will only have a physical card and a web app. The company plans to release a mobile app soon, which costs €30 to sign up. The blockchain firm further said that the services let users spend EUR, a stablecoin pegged to the euro, on the Gnosis card. Gnosis Pay is working on integrating MakerDAO's decentralized stablecoin, DAI, for future payment options. Currently, if you're out of EUR, it'll decline the payment, Ernst added. A feature we will add in the future is that if you're out of EUR but have USDC, for instance, it will ask whether you want to swap your tokens. Furthermore, Ernst noted that the Gnosis team is having talks with wallets interested in their infrastructure. We are currently signing letters of intent with multiple wallets. It is likely the first ones are going to be Ethereum and Bankless, 1inch are also top of the list. Bitcoin and other cryptocurrencies are getting ready for more gains as stocks try to add to their recent gains. Several macro factors drove the recent rise in a number of asset classes, but experts disagree about how long the current bullish trend will last. Many people have been waiting for a long-awaited slowdown and a return of the 2022 bear market, but neither has happened so far in 2023. In fact, most assets have found buyers, and on July 12, the Nasdaq hit a 52-week high. How is this possible? Will the rise go on? Michael Burry, who wrote The Big Short, said in January that the U.S. could be in a recession by the end of 2023 if the Consumer Price Index, CPI, went down and the Federal Reserve cut interest rates. The CPI came in much lower than expected last week, which helped the recent rise even more. He thought this would cause another rise in prices. In a newsletter that came out this month, independent macro and crypto analyst Lynn Alden talked about the subject. In the study, Alden looks at inflation by comparing it to the 1940s and the 1970s, two times that were similar but different. From this, she comes to the conclusion that the U.S. economy is likely to stop growing or go into a mild decline while inflation stays at some level. This could mean that the markets will keep going up until there is a real slump. The Fed's fight against inflation goes on. Alden thinks that fast bank lending and big monetized fiscal deficits, which are the main differences between the two times, are the real causes of inflation. The first one happened in the 1970s when baby boomers started buying homes. And the second one happened during World War II to help pay for the war effort. The 2020s are more like the 1940s than the 1970s, but the Fed's monetary policy is still based on what worked in the 1970s. This could end up doing more harm than good. Alden says, so. When the Federal Reserve raises interest rates, federal interest costs go up and the federal deficit gets bigger. This is ironic, because deficits were the main cause of inflation in the first place. It could be like trying to put out a grease fire in the kitchen with water. Which makes sense, but doesn't work the way you'd think. In other words, new federal debt, or what some people call government money printing, is the main cause of inflation today. The Federal Reserve has raised interest rates by 500 basis points in a little more than a year, which has cooled some parts of the economy. However, the Fed hasn't done anything to fix what's causing inflation in the first place. With a debt-to-GDP percentage that is much higher than it was 50 years ago, things will only get worse more quickly. But markets have stayed strong. Even though the link between tech stocks and cryptocurrencies has broken. In this way, the Fed may be using a tool that isn't right for the situation, but this hasn't stopped markets, at least for now. Big tech beats predictions of a slump and drives up stocks. Even though the Fed is fighting inflation and the market thinks a recession is inevitable, the first half of 2023 has been a good time to buy stocks, and the rise has continued into July. Yields on bonds have gone up again, and risky assets like tech stocks have been going up like crazy. It's important to remember that Nvidia, Apple, Amazon, and Google are among the 7 stocks that have led this rise. These stocks have more than their fair share of the Nasdaq. Increasing interest rates can help stop inflation. But it only works for inflation that is caused by a rise in credit tied to bank loans. Higher rates bring down inflation by making it more expensive to borrow money and lowering the number of loans given by the private sector. However, they make fiscal deficits worse by increasing the amount of interest that is owed on debts. The government debt is now more than 100% of the gross domestic product, GDP. In the 1970s, it was only 30% of GDP.